Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Moolec Science.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, let's set the stage for you. Our mission today is to decode an early-stage, highly disruptive agritech company.
Right, we're looking at a classic extreme asymmetry wealth building scenario.
Exactly. It's the kind of high-risk setup that can absolutely make a portfolio if you get the timing right, or, completely break it if you misunderstand the mechanics of what you are actually buying.
And the mechanics here are incredibly specific. I mean, you are navigating a structural set of risks that require a very cold, calculated approach. We're looking at a situation with immense upside potential, but, well, it's buried underneath the financial profile that scares off the vast majority of casual investors.
Which leads us right into the core paradox of today's analysis, because I'm looking at the raw data, and we have a company with a balance sheet that would normally make any sane person run for the exits.
Run far away.
Right. Yet at the exact same time, our models are flagging this as a 7 out of 10 bullish score for a 3 to 6 month speculative swing trade. So how does a company with financials that look, frankly, technically bankrupt, suddenly become a prime candidate for a massive speculative breakout?
It's a great question. And to answer that, before we even touch the price action on the charts, we have to understand what this company actually builds and why it is burning cash like rocket fuel.
That's the only place to start, because I want you to imagine taking a regular green pea, planting it in the dirt, and eventually harvesting a literal steak. I mean, that is the science fiction reality we are unpacking today.
It really is. Because when you're dealing with early-stage biotech or agritech, current financials do not reflect the current value of the company.
No, they reflect past research and development.
Exactly. What you're actually buying into is the future commercial pipeline. And Moolec Science has built an entire competitive moat around their proprietary molecular farming intellectual property.
Molecular farming.
Yeah, they're currently navigating this crucial, incredibly expensive transition phase, moving out of the pure R&D lab and into a scalable commercialized product pipeline. We're talking about patented products with names like Chymosin SPC, GLA SONOVA, POORK plus Sci, and Beef plus FAR.
Okay, let's translate molecular farming into plain English for the listener, because it sounds like a buzzword, but the reality is just staggering. We talked about the green pea a moment ago. Here is how you should visualize this. Moolec has figured out how to take the genetic code that produces bovine myoglobin,
which is the literal protein that makes beef look, taste, cook, and bleed like real beef.
Right, and they insert that directly into the DNA of a plant seed. You aren't just growing a vegetable anymore, you are turning that single plant into a microscopic meat factory.
It's a profound shift in how we think about food production. I mean, instead of breeding a cow, feeding it massive amounts of grain and water for 2 years, and then processing it,
the plant does all the heavy lifting.
Exactly. You plant the modified seed, you let the soil and the sun do their natural job, and the plant expresses the meat protein.
It completely bypasses the cow, and maybe even more importantly for the industry economics, it bypasses the immensely costly stainless steel bioreactors that other lab-grown meat companies have to rely on.
That is the crucial distinction that the market is just starting to price in. Because lab-grown meat requires massive capital expenditure. You have to build sterile facilities, run continuous power to giant bioreactors, and maintain perfect thermal conditions.
It's extremely infrastructure heavy.
Yeah, very. But Moolec's approach utilizes traditional agriculture. They recently achieved a first-of-its-kind breakthrough by successfully expressing bovine myoglobin inside pea seeds, which proves their platform can scale beyond just soybeans.
Oh, wow. So they're proving it works in different crops.
Right. And by using soil and sun instead of steel and electricity, they are establishing a system with drastically lower long-term input costs. That creates incredibly high switching costs for any future food manufacturers who integrate these cheaper-to-produce ingredients into their supply chains.
Because once a partner switches to Moolec's protein, they aren't going back to expensive bioreactors.
Never. The economics just wouldn't make sense.
I understand the science, and, it is brilliant. But I have to play devil's advocate for you listening at home, because the financial reality is staring us right in the face.
Yeah.
Quarterly revenue estimates are sitting at roughly $2.64 million.
Yeah, which is actually down from previous estimates of $3 million.
Exactly. And they are projecting an expected earnings loss of $16.50 per share. And the pre-tax profit margin, it is a staggering negative, 177.6%.
The cash burn is brutal. There's just no sugarcoating a negative 177% profit margin.
There isn't. And it gets worse. Let me ask the obvious question here. You have a book value of negative $90.85 per share. You have working capital sitting at a massive negative $204.86 million.
It's a tough pill to swallow.
How is this not a sinking ship?
Mhm.
How do you justify putting hard-earned capital into something that is over $200 million in the red? It feels less like an investment and more like throwing money into a black hole.
I completely understand the skepticism. I really do. But here is the aha moment for navigating this specific sector. Biotech is one of the only industries on Earth where a company can look technically insolvent on paper while actually executing its business plan perfectly.
Wait, really? Explain that.
Well, that negative $204 million in working capital is the cost of digging the moat. You have to spend hundreds of millions of dollars to validate the science, run the trials, and secure the global patents before you can sell a single profitable ton of product.
So the horrific balance sheet isn't a sign of failure, it's just the required entry fee for the industry.
Exactly. It's a feature of this capital-intensive R&D phase, not a bug. And the smart money is beginning to notice that Moolec is finally crossing the cusp out of R&D and into commercialization. I mean, crucially, they just successfully maintained their NASDAQ listing, which resolves a major overhang of compliance issues.
Right. Getting delisted would have been a disaster.
Totally. But the real tell, a metric that changes the entire dynamic of this trade, is what the short sellers are doing. They are running for the exits.
This is a massive point. Almost 85.8% of the short interest was just wiped out. It dropped down to a mere 2,460 shares. Why the sudden panic from the bears?
You have to think about the psychology of a short seller in this scenario. They make money when the company goes bankrupt. For the last year, looking at that negative working capital, betting on Moolec to go under seemed like a sure thing.
Right, it looked like free money.
Exactly. But then the company announces the scientific breakthrough. They prove the bovine myoglobin works in peas. Suddenly, the short seller realizes the science is real and it's scalable. The risk of sudden bankruptcy plummets. They decide the downside bet is no longer safe, so they buy back their shares to close their positions before the stock can surge against them.
And that mass exodus leaves a giant fingerprint on the chart. That brings us to the technical analysis, because the evaporation of short interest connects directly to the recent psychological shift on the stock chart. The bears retreating has fundamentally altered the price action.
Yeah, if you look at the daily structure, Moolec is exhibiting a classic volatile base-building pattern. Over the last 12 months, the stock endured a grueling decline, dropping 89.07%.
For retail investors who held through that, I mean, it is absolute agony.
It's terrible. But the mechanics of the market dictate that eventually, selling exhaustion sets in. There's simply no one left who wants to sell at these depressed levels. The stock has officially flipped from a downtrend into a consolidation phase.
Let's break down the moving averages and the momentum, because trading right around $10.80, the technicals are shifting fast. It has recaptured key short-term moving averages. It's sitting roughly 28.1% above its 20-day simple moving average.
And about 21.8% above its 50-day SMA, too.
Right. Now, it is still almost 49.7% below its 200-day moving average, but reclaiming those shorter-term lines is the critical first step of a localized breakout.
Recapturing the 20-day and 50-day moving averages is the market's way of signaling a definitive shift from bearish to neutral, or even bullish momentum in the short term. It proves that buyers are willing to step up and accumulate shares at higher prices today than they were a month ago.
And this is supported by the Relative Strength Index. The RSI is sitting right at a neutral to bullish 58.88.
Which means it has plenty of room to run before becoming overbought.
Right. It tells trading algorithms that the stock can still surge significantly before triggering any automated profit-taking. What are the next resistance levels we're looking at?
The next major psychological hurdles on the chart are at $12.23 and $12.50.
Okay, I want to connect that to the volume and the short squeeze potential, because this is where the asymmetry gets really interesting for you as a trader. The days to cover ratio right now is virtually non-existent. It's sitting at 0.2 days.
Yeah, that is incredibly tight.
If the float is this tight and we are seeing pre-market surge activity, what happens if a positive headline drops tomorrow?
Well, a 0.2 days to cover ratio means if every remaining short seller panicked and tried to buy the stock back, It would take them barely any time to buy up the available supply if the supply was even there. That is the exact mechanism of a momentum-driven short squeeze.
So it's basically musical chairs, but someone is guaranteed to be left without a seat.
Exactly. Any sudden influx of buying volume will completely overwhelm the float. If a positive catalyst hits the wire, retail and institutional buyers will flood the bid. The few remaining short sellers panic, hit the buy button to cover, and because the stock just spent a year clearing out weak hands, there isn't a wall of overhead supply. The price just gaps up violently.
And that technically prime chart links perfectly to how Wall Street and the big institutional players are suddenly changing their tune. We're seeing this technical breakout reflect in broader market sentiment. But it is a very bifurcated mood right now, isn't it?
It's entirely split. I mean, if you look at recent market feeds, broad market sentiment is weak, and long-term outlooks remain very cautious. But amid all that weakness, Moolec Science is popping up as a top gainer.
Yeah, it's gapping up in pre-market sessions.
Right, because of its fundamental breakthroughs. Wall Street Zen has even upgraded the stock from a sell to a hold.
Which, doesn't sound like a screaming buy recommendation. But in the context of a stock that was left for dead, an upgrade to hold is a massive signal. It tells the market the worst of the downgrades are probably behind us. And then we have the institutional moves. Citadel Advisors recently purchased a new position of 36,218 shares.
Yeah, that was valued at roughly $36,000,
Yeah.
giving them a 0.90% stake.
I compare this to a whale dipping a tiny toe in the water. I mean, a dollar amount is small for them. $36,000 Citadel is pocket change.
Oh, absolutely. It's nothing to them.
But a Tier 1 market maker taking a position provides a speculative floor for this microcap, doesn't it?
It does. Citadel isn't taking a $36,000 position to hold it for a decade as a value investment. They're laying down infrastructure. They're setting up algorithmic traps to capture volatility. By stepping in, they validate the microcap thesis and tell other algorithms that the stock isn't going to zero tomorrow.
And that institutional toe-dip is happening alongside a very active rumor mill. When you combine that negative working capital with a sudden technical breakout, people start talking. What are the rumors saying right now?
Given the cash constraints, the primary speculation revolves around a non-dilutive strategic partnership or a licensing deal with a major food manufacturer.
That makes a lot of sense.
It's the logical next step. They just proved their tech works in peas. A legacy food giant looking to lower their long-term protein costs could step in, offering upfront cash in exchange for exclusive licensing rights. If that happens, it completely removes the bankruptcy risk without diluting current shareholders.
Which is the ultimate lifeline. Okay, so moving from unconfirmed rumors to hard deadlines, what are the specific dates you need to circle on your calendar to watch this narrative unfold over the next 3 months?
The first major date is the upcoming estimated earnings, which is around April 20, 2026. Now, the revenue numbers themselves will likely just meet consensus. The numbers aren't what you're listening for.
What should investors be listening for then?
You need to listen closely for forward guidance on the commercialization timelines for GLA SONOVA and the Beef Plus product lines. Any hint that they're accelerating that timeline is a major bullish catalyst.
Got it. And beyond the earnings call, CEO Alejandro Antalich is hitting the conference circuit. He'll be presenting this bovine myoglobin in peas data at several upcoming agritech and biotech conferences.
Right, getting this validated data in front of a broader institutional audience is critical for securing those strategic partnerships. Furthermore, the company perfectly aligns with ESG mandates, environmental, social, and governance. Obviously, growing meat proteins inside plants has a drastically lower climate impact.
Okay, let me stop you there and push back on this hard. Does ESG momentum actually drive capital into a microcap, or is that just corporate buzzword bingo? I mean, blindly buying a company with a negative $200 million working capital just because it's green sounds like a great way to lose a lot of money.
It's a totally fair challenge. But you have to understand how thematic fund accumulation works. There are massive ETFs with strict ESG mandates. They're required to allocate capital to sustainable technologies.
Oh, so they're forced buyers.
Exactly. When macro conditions ease, their algorithms screen the market for companies that meet specific ESG criteria and possess validated IP. As Moolec de-risks the company, they become eligible for passive inclusion in these thematic funds. They buy the theme, not just the short-term financials.
That makes a lot of sense. But speaking of those financials, I want to insist on a reality check. We've painted a picture of exciting science and technical breakouts, but it's time to look the monster in the eye. What are the actual risks here?
The single largest risk is financial insolvency. We cannot ignore that massive negative $204.86 million in working capital and the negative book value.
Right.
A secondary stock offering that dilutes existing shareholders is a massive threat unless they secure debt financing or partnerships first.
And I want to be clear about dilution. To survive, they might issue millions of new shares. The more shares they print, the less your original investment is worth.
Dilution is the primary wealth destroyer in early-stage biotech. And on top of that, you have immense execution and regulatory hurdles. Scientific success does not automatically equal commercial yield or regulatory approval globally.
True, but to offer a point of mitigation, shifting their molecular farming to peas, a crop with massive established global supply chains, significantly lowers the industrial barrier. They don't have to build expensive bioreactors. Farmers already know how to grow peas at scale.
That is their greatest operational advantage for sure.
Okay, let's bring this conversation full circle. We've weighed the futuristic molecular farming IP against the distressed balance sheet to deliver the final verdict for your wealth-building strategy. What is the elevator pitch?
The elevator pitch. Moolec Science is a highly asymmetric turnaround play. With short interest wiped out and the shift from pure R&D to a scalable commercial pipeline, it earns a bullish score of 7 out of 10 for a speculative swing trade over the next 3 to 6 months.
It's a fascinating setup, but I want to leave you with one final lingering question to ponder. If Moolec's method of growing meat proteins inside cheap, globally accessible plants becomes the industry standard, how does that fundamentally rewrite the economics of the multi-trillion-dollar traditional agriculture and meatpacking supply chain?
It changes everything.
It really does. And ultimately, which massive legacy food corporation will be forced to acquire them just to survive? Thanks for joining us. Keep your eyes on the charts, and we'll see you next time.